All right, team. Well, thank you for your time this morning. My name is Ralph. I'm with Rise Mortgage, and today we're going to be talking a little bit about non-QM loans and what they're about, what you do or do not know about them, and uh, opportunities that are being missed and opportunities that are coming, and how that can affect you and how it can help you grow your business, and most importantly, give you guys a little bit more cash in the pocket. So give you a little bit about what we do, right? As far as a lender goes, and this is not just myself, but just about anybody, right? Most lenders worked on mostly your standard conventional FHA, straight down the middle loans, right? 80% of all business is that. And about 20% of the rest of the business that we do are portfolio non-QM products, non-traditional loans, bank statement loans, things that are outside the box, if you will. Right? And that 20% is what we're going to be talking about today, and giving you a little bit more detail as to what to look for, how they work, and how we can start growing that business, especially going into 2025. There is a huge pent up demand that all of us feel that is going to happen, right? So by knowing how these products work, knowing what to look for, there's a huge opportunity to make a little bit more money, right? So if you close, say, 3 more deals a year, that can put an extra 50K in your pocket, which is not $5, right? It's a good amount of money, make a whole difference in your year. Okay. Now, to help me and further explain the details of these products, I have brought on a good friend of mine, Scott. Scott is a account executive with Angel Oak. Angel Oak is the largest, if not the largest, one of the largest, and also the most seasoned mortgage companies for the non-QM space. Scott is also the #1 account executive for Angel Oak for the last, 2-3 years running now. We've been friends for over 20 years, doing business together for over 20 years. So someone that I know and trust, and is the absolute expert in this space. So, Scott, if you don't mind, go ahead and give us a little more detail as to what's going on with these non-QM loans.
And thank you. Thank you very much for the introduction, Ralph, and thank you for inviting me on here to share some knowledge and some information with everybody on here about the non-QM space. Guys, I'm coming to you live from New York City, so if you happen to hear any background noise, I apologize. But as you know, it can get a little bit loud here. But yeah, so I love speaking about non-QM and the opportunity it presents, especially to the realtor community, because we found that the realtor community may not always know a lot of the different details that are available. And as Ralph mentioned in the previous slide, the goal here is really to give you guys more tools and more information to be able to close, if it's 1 extra deal, 2 extra deal, 3 extra deals a year. By having that knowledge, that's 100% worth it. So we're going to talk about who these types of buyers are. We're going to talk about how these programs work, and we're going to dial in directly with the ones that are going to probably add the most value to your day-to-day business, and the type of buyer that you're going to be able to help the most. Most of these buyers in the non-QM world are going to be either self-employed borrowers or they're going to be investors. We do work with a lot of borrowers that may have had credit events in the past. We like to say a lot of times bad things happen to good people. They may have had an issue with a foreclosure, a bankruptcy, etc. And conventionally, there may not be a lot of options for them, but in the non-QM space, we do have options. There's also a huge opportunity in the condo space. We do non-warrantable condos. That's a big issue and a big topic right now, especially in certain areas like South Florida. So those are the different types of buyers that we are going to be helping, and the type of home buyers you're going to be helping out. So we're going to start off with the most popular program that we offer, and the one that non-QM really is known for the most, which is bank statement programs. This slide kind of goes into, are you missing deals because you're not aware of loan options for self-employed borrowers? In the conventional space, of course, self-employed borrowers have to show their tax returns and their income in order to qualify. We have alternative sources of qualifying those buyers. We can help self-employed borrowers qualify using income on the cash flow of their actual businesses. that may not necessarily be reflected on their tax returns. So to give you a little snapshot here, these are 1099 earners. These are, in most cases, jumbo borrowers. These are people that fall out of agency or conventional loans because they did not claim enough income on those tax returns. And most importantly, these are business owners. And what we're able to do with these self-employed borrowers is we're able to qualify them using the bank statements for, so if you have a business owner, we can use their business bank statements to qualify. If you have a 1099 Schedule C type of individual, we can qualify them using their personal tax return. So I like to always, especially with this group, use realtors as an example. Realtors, you guys all get paid 1099. And I probably close 3 or 4 loans a month for realtors. You guys all get paid 1099, and that income is usually going into your personal bank account, or maybe you have a PA set up, right? And it's going into the PA account. We're able to qualify you using those deposits that are going into that personal or that business account. We total up the deposits, we do an income calculation, and we're using your real income. Obviously, all self-employed borrowers, 1099 or business owners, are going to take significant write-offs on their tax returns, as you should, to take advantage of the beautiful tax laws that are offered in this country, right? So by using those bank statements, we're looking at what your true income is and your true cash flow is. There's another option we also offer called a 1099 only option, where we can look at strictly the 1099 and the gross income on the 1099 and qualify the buyer using that number. And then we can support that usually with an income statement or a couple of months of bank statements to see that the income is still in line this year with what that previous year's 1099. So there's a lot of options for these buyers. I think this is the one that'll probably impact your businesses the most, because it's historically always been in the non-QM space, the #1 producer from a volume standpoint. Here's some interesting statistics as well, and then we'll go into an actual live scenario. But we run these numbers on a monthly basis as a lender. Our average bank statement borrower usually runs a 700 to a 740 credit score on average. Typically, those loan to values on those loans are below 80%, somewhere in the 70s. And the average loan amount can vary, but they're almost always well over 500,000. Point being is, these are borrowers that have excellent credit, borrowers that have assets and have funds that they can purchase larger properties with. And in most cases, we're seeing jumbo loans being done by these borrowers. It's out there, but it's very rare, or I should say the percentage of individuals out there on a W-2 that are making, $300,000, $400,000, $500,000 a year, it's not a large part of them. But on your self-employed borrowers, on your business owners, your 1099 individuals, your entrepreneurs, that's actually quite common. So for that reason, we see a lot of those jumbo loans. So we'll go into a live scenario here. Okay, here we go. So this slide says, are you losing out on closing deals because buyers are self-employed? Quick scenario: self-employed buyer makes $200,000 per year and has a credit score of 758, writes off 75% of his income. That's common. He's left with 50,000 trying to apply for a jumbo loan. He does not qualify. Solution: bank statement program, as we just mentioned. We were able to approve this borrower for a $750,000 loan. Buyers got the keys, sellers got their proceeds, everybody went home happy. So, and Ralph can speak to this because him and I have done so many of these over the years, where borrower comes in, self-employed, brings in their tax returns, only showing that 50,000. We do a calculation on the bank statements. And I mean, we're talking the buying power literally, sometimes 100x. We could see bank statements that show us 50,000 a month in income because we're calculating the deposits. Think about as a realtor how powerful that is, because that income calculation, by the way, guys, is done up front. We do that on the front end before the borrower ever applies or even, has their credit looked at. So now you as an agent know that you can go out there comfortably showing this buyer properties, knowing that the income has pretty much already been approved up front and you have a very well qualified borrower, and we're using their true buying power by looking at those bank statements.
And to Scotty's point, when January comes around, we're going to get we always get a lot of calls of buyers. Hey, can you look at my tax returns? Can you help me qualify? And those buyers that are purchasing seven, 800,000, $1 million homes, in order to qualify, the amount of money that they have to pay in taxes just to get their income to where we need it to be usually exceeds the amount of money that they need for down payment. So it's a matter of, what do you want to do? Do you want to give your money to the IRS, or you want to invest it into your home? And
Right.
more times than not, we'll end up going with a bank statement transaction. They get it done. They can file their taxes as they always have, and not have to pay absurd amounts of money to the IRS. And we're getting them into their home. So it's very, very common for us to analyze them in the beginning of the year and then advise them, right? Hey, do you want to go this way? Do you want to go that way? At the end of the day, it's your money. How do you want to spend it? So that's where these opportunities come into play, and how we can continue to service all of our customers.
It's a great point, Ralph. And a lot of time when these buyers come in the door for us all here, because it always starts at the realtor level, without agents, here on the mortgage side, we have no business, right? But when that buyer comes in the door, they're usually wanting to do something right away, right? They're interested in making a move right away. And so, timing wise, this also gives you the opportunity to take that buyer and get them into a home right away versus having to go back and refile taxes and take the time that's required and then obviously pay that large amount. The other question we usually get a lot that I'll address now is, oh, okay, so then, what do the rates look like on these programs? Because to your point, it's, and most self-employed borrowers understand, like, look, I'm not paying Uncle Sam the full amount because I'm taking the write-offs. So I have to understand that when I go get a loan, I'm not going to get the best rate out there. The pricing and the rates on non-QM loans, in some cases, you're talking about only a half a point higher than what you're seeing conventionally, maybe as far up as close to a point. So you're not far off from a pricing wise where that borrower is going to be from if they did file their tax returns and claim all their income and pay that huge tax bill and then go get a loan. The difference is minimal. So shifting over here to our basically borrowers who have had credit issues, credit events in their life. Are you missing on deals for home buyers that have had a recent life or credit event? This will keep pretty straightforward. Conventional has some very strict and specific guidelines in terms of the seasoning for a foreclosure, for a bankruptcy, etc. With us, our seasoning is a lot more lenient. As I mentioned, bad things happen to good people sometimes. Doesn't mean they shouldn't be able to get financing to purchase a home. So we had one here where borrowers are affected by credit events such as a forbearance, a bankruptcy, foreclosure, short sale, loss of a job, divorce, medical issues. We basically have solutions for most of these that are going to be a little more lenient than conventional. For example, our seasoning for a BK is only 2 years. 2 years after Chapter 7, you can qualify to purchase a property with us. If the borrower had a Chapter 13, we do it differently than conventional in the sense that we use the filing date as the seasoning date that we're looking at. So if a borrower came out of a Chapter 13 BK, as we all know, those are usually 3-year repayment periods. If we're looking at that filing date, we're instantly already seasoned, and that buyer can purchase a property basically a day after completing their Chapter 13. They don't have to wait 2, 3, 4, 5 years from there. Foreclosures. If a borrower had a foreclosure recently, happens. We have a program where we can finance a loan for that borrower 1 year out of the foreclosure instead of having to wait the longer periods that are required conventionally. So again, the whole purpose of non-QM is to give buyers more options to get into homes today quicker as they help and repair their situations that they may have from a credit standpoint or from an income standpoint. So here's a live scenario. By the way, guys, these scenarios we're going over, these are actually live loans that have closed here with Angel Oak. Last week, we had a $1.3 million home for a family that was turned down by 2 other lenders due to a foreclosure that occurred 2 years ago. On our full doc program, we call it our Portfolio Select. We enabled this grateful family to move into their dream home just in time to enjoy their staycation. Portfolio Select program only has that 1-year seasoning on the foreclosure event, as we had mentioned earlier. Okay. All right. Well, shifting over now into investors. Are you missing out on deals because you think real estate investors don't qualify? These borrowers are individuals, LLCs, looking to acquire and hold properties as rentals. So a lot of you guys on the real estate side, I'm sure, are familiar with the DSCR program. The DSCR program is probably the second most popular program we see in the non-QM space after the bank statement program. And this is basically what this scenario is speaking to. An investor is looking to purchase her 19th investment home. Her prior funding was very costly because it was a hard money loan with high rates and fees. She was unable to qualify for a mortgage using tax returns. After a rental analysis was completed, she was able to qualify using an investor cash flow program. That's what we call our DSCR, guys. The investor was able to purchase her 19th home. So DSCR programs, the way that these work is we are qualifying the buyer based on what the rental income is that the property they're purchasing generates, strictly for investors. Now, there are a ton of options under this program. If you have buyers that come to you, they want to purchase an investment property, keep in mind, they don't have to always own a primary residence. They can be first-time investors. If the rent that the property generates doesn't cover the mortgage payment, there are still options to qualify that loan. In some cases, we have what we call a DSCR waiver, where we can actually waive the requirement for the rental income and we'll qualify them based on putting a little bit more money down in their credit. We can use short-term rentals. So if it's a property they're intending to do an Airbnb or VRBO, we can use the short-term rental by going through an AirDNA comp or by getting the rent schedule, the 1007, with the short-term rental comps. A bunch of different options available, but the DSCR program has exploded in the investment community. Seasoned investors, who I'm sure many of you work with, are aware of the program. They seek it out. In years past, they used to have to go with hard money. And as we all know, those are higher interest rates, much more down payment, a lot of points up front. The DSCR program has really given investors the flexibility to purchase more properties and build their portfolio, which obviously helps everybody on this call. So as agents, keep that in mind. There's a lot of flexibility. This program has evolved so much over the last 12 to 24 months. If you look at it, no income verification, no employment verification. We're not looking at DTI. We're literally just looking at the subject property and the rent that the property generates. And as I mentioned, numerous options there. Some also really cool and fun features that you can offer your buyers on this program. There is an interest-only option. As you guys know, with investors, it's usually all about cash flow for them when they're looking at a property. So by putting them into an interest-only payment and reducing that monthly obligation, you can help them generate more income that way. We do allow borrowers to purchase and close in the name of an LLC. They can also close in the name of a corporation, and they can close in the name of a trust. So there's a lot of options there. A lot of these investors are using those different options for tax shelters and liability shelters. Those options are available. Yes, like I said, a lot of flexibility here in this program. So definitely want to keep this in mind when you have an investor. Okay, moving to the next slide. Are you losing out on closing deals because sellers aren't accepting your buyer's offer? A buyer placed an offer on a property after the property only to have the seller select another offer. This buyer has plenty of cash to buy the property, but they didn't want to keep it tied up in the property. Solution, our delayed financing program. Buyer used their holdings to put in a cash offer, was more attractive to the seller. Then within 6 months, they applied for a mortgage to recoup most of that cash back. It's treated as a purchase, not a refi, so there is no hit to the interest rate. So this is an interesting one, delayed finance. I'm sure you guys are familiar with this. If you think back, agents, to 2021, 2022, how many, when we had those bidding wars for properties, right, where every property had 10, 15, 20 contracts on it. And a lot of people, especially in the investor community, what they were doing was they were going in and they were buying these properties cash to secure the property. We feel industry projections are looking at that we might be entering back into that type of market, maybe not to that extent, but close to it. Once we see interest rates start to come down a little bit more, which we're all expecting, we could possibly start to see that market. And that's where this program really becomes a huge tool, very helpful and beneficial, because if we go into that market where your buyers say, okay, I'm going to buy this property cash, you as an agent can feel comfortable knowing you can go to Ralph and he's going to be able to use a delayed financing program to where the next day after closing on that property in cash, we're going to be able to go in there and do a loan and recuperate that cash that they utilize to put that money back into the borrower's pocket and put them into a little bit more of a traditional loan, where at the end of the day, they may have only come out of pocket with 20% or 10%. As this slide mentions, we qualify it like a purchase, not a cash out refi. So if that borrower was using financing to purchase that property, that financing would allow them to qualify, let's say, for 15% down or 10% down. That's exactly what the loan will be for them when they come back and do the delayed financing. Basically, the point is they're not penalized in any way, shape, or form for having purchased that property cash and then coming to get a loan after they closed on that property. So I think that one's going to be a good tool for you guys. Are you guys losing out on closing deals because buyers are watching their cash flow more closely? With the increase in property values and rates, more monthly mortgage payments are on the rise. Borrowers may not want to tie up as much of their monthly budget in their mortgage payment. Solution: interest only. This loan starts with the first 10 years as an interest only. Then it turns into a 20-year fully amortized mortgage. The borrower must qualify off of the full 20-year amortized mortgage. We will also recast the monthly payments when the borrower pays more to a balance in any given month. Perfect for those buyers who are expecting a big lump sum they can then apply to their mortgage. So I think this interest-only program is probably not utilized enough in the non-QM space. As agents, you can know that interest-only can be applied to basically every program that we offer. You can apply it to the bank statement program, full doc programs, and also the DSCR program. You can keep that borrower's monthly payment down by utilizing the interest-only payments, knowing that they still have the flexibility on a primary residence or a second home to pay down the principal balance. And as they pay down the principal balance, there's no penalty and their payment actually comes down. You can do that on an investment property as well. In some cases, investment properties may carry a prepay, so they would only be able to pay off maybe 20% of the principal balance in any given year. But on a primary and a second home, they can pay down as much as they want. So to kind of give you an idea how that works, if you took a mortgage today, $200,000 mortgage, your monthly payment's $2,500. Interest-only payment, this month you went to pay your mortgage, you paid an extra $50,000 down on your principal. The following month, your monthly payment is now based on your $150,000 new principal balance. So your monthly payment actually came down. And it stays this way for the first 10 years where you have this feature. It's a really cool way for buyers. Again, most of the time it's going to be self-employed entrepreneurs, the types of buyers whose cash flow maybe fluctuates throughout the course of the year. And at times they have extra cash that they can pay down on the principal balance. It's a great tool for those types of buyers for you to offer. All right. So to kind of summarize, clients can buy a home now without having to wait if they're self-employed, if they're jumbo, using their bank statements and their true buying power, if they've had credit issues, life events, and investors. We're able to save a lot of these deals because we work with a lot of these buyers every day. Kind of speaks back to what Ralph mentioned. Ralph and I have been working together, like I said, over 20 years. We've closed a lot of loans together. And we've been able to save a lot of loans together, really help buyers get into homes that otherwise we're told they couldn't. By using or leveraging a lot of these programs, and I think it'll do the same for you guys. That is the whole idea of the non-QM space. When non-QM was rolled out again back in 2014, the whole goal was to give a buyer options to get into properties, open up the door and the opportunity for more homeowners to get into properties. This kind of gives you just some slides of what kind of market you guys are looking at and what kind of market you're dealing with. Go back there. So self-employed borrowers, 36% of the U.S. workers are gig workers in some capacity. We see this every single day. You guys probably see it every single day. You might have a buyer that comes to you and they have a W-2 position for their primary employment, but maybe they do some Uber on the side and Lyft on the side. Maybe they sell products online on the side. Maybe they offer some sort of, other service on the side where they're self-employed. Gig economy where people have multiple streams of income. You have a lot of them today. They all fit into the self-employed bank statement program. Investors, over 36% of homes are actually rental properties today. You as realtors, I'm sure have seen a huge amount of people going in and saying, okay, we want to begin investing in real estate, building a portfolio. 10 to 11 million is the number of individuals of investor landlords managing an average of 2 units apiece. So huge market there. Um, and to the slide earlier for self-employed, for all of those that are located in South Florida historically has led the country in new business formations. I think it's the last 4 years in a row. So it's a very big market there. Where can we find these borrowers? Well, social media. You can post a lot about these products and programs, and Ralph can help you because we offer a lot of options for you to have different posts specific to these programs, bank statements, DSCR, etc. You can revisit any of your recent turndowns, anybody that maybe you thought of that said, oh, wow, okay, this person didn't have enough income at the time. They were self-employed. They were only claiming X on their tax returns. Maybe we can go back to them. Keep in mind as agents that builders and developers, usually their in-house lending does not offer these types of products. So as a realtor, you could probably leverage some business there as well. Accountants and CPAs, these are also a great referral source to refer you guys buyers. They work with these individuals day to day, especially during tax season where they could say, hey, look, I know you're self-employed. We made these write-offs on your tax returns. You can still purchase a property if you want to. Here's a realtor that can help you get that done. And financial planners. Financial planners are always a great source of referrals. BK and divorce attorneys. Remember, guys, that on a BK, there's always usually 2 transactions there, especially if there's a property that's currently owned. One of those individuals is going to keep the property. The other one's going to have to move out of the property and purchase a new one. So there's always opportunity there for you guys as realtors. And then obviously in your own sphere of influence. Kind of little, when I do presentations for loan originators, and they say, okay, how do we find these bank statement borrowers? And I'm like, literally just go outside. You're tripping over them, right? If you go into the coffee shop, the restaurant you frequent, your dry cleaners, these are all people that are business owners. They're all individuals that are self-employed and they're out there for you. So right within your own sphere. And what we find is that, when you do a loan for a buyer, when you sell a property to a buyer that's self-employed, a lot of those self-employed buyers know a lot of other self-employed, right? They usually hang within the same circle. So you have a big sphere of influence there that you can tap into. Do not tell yourself a self-employed buyer. Do not tell your self-employed buyer to not claim deductions for 2 years. So that, sorry, let me go back there. So they can qualify for a conventional loan. We touched on this. You don't need to have them go and change their tax returns. If they filed X amount of income for the last 10 years, you don't need to all of a sudden have them file this huge jump in income. We can use those bank statements to qualify. They will miss out on 2 years of appreciation and tax benefits in the hope of maybe saving a little on the rate. And who knows where interest rates will be in 2 years. That's kind of what Ralph and I spoke to earlier. From a timing standpoint, there's obviously a lot of value in being able to get that borrower into the property today using the bank statement program, even if the rate's just a slight bit higher. Instead, call Ralph first.
Yeah.
Help you call Ralph
Exactly,
first to advise.
and that's what I always tell everybody. You never want to assume that they don't qualify. You never want to assume that they're not willing to do this, that, or the other. You never want to assume that they might be scared by the interest rates. At the end of the day, our goal is to get them into their house. As the saying goes, there's more than one way to skin a cat. So we want to make sure that they're shown every single option. At the end of the day, if someone has they have the desire to buy a home, they've got some cash in the bank, and they're working, right? Whether it's self-employed, employed, or whatever, send them our way. Send them my way. Let me talk to them. Let me be the one to explain to them how things work so that they know what their options are, right? The idea is to get them into a home. If they want to be an investor, and they're like, oh, I want to be an investor. How do I start? Let's explain to them how it works. Like explain to them how they're able to become that investor and start building their portfolio. Does it take cash? Yes, it takes cash. Do they know where to start? Most of the time they don't. They heard from a friend, from their next door neighbor, from something they read on Google. At the end of the day, don't turn them away. If they call you, if you speak to somebody and they have an interest in purchasing a home, send them my way, send them our way. Let's us get that, drill in, ask them the questions, give an opportunity for them to ask us the questions, so that we can truly get them ready to purchase a home and get them going. So I appreciate you, Scott. I think that's the pretty much the end of the slides that we got. So does anybody have any questions for myself or Scotty, or anything that you would want us to deep dive in a little bit more? I think we have a few more minutes as needed.
Hey, good morning. I have a quick question.
Sure.
All right, so I'm working with a client that works with crypto. He gets paid in crypto from an offshore company. So he has no 1099 and no W-2. So the bank statement is not an option. At least from what I've been told. Is that true? Or is there still a way to get him approved with a bank statement? Because he has the money in the bank. Like you could see that he's making money. He has money to cover the mortgage. But the fact that we can't get a letter written from a U.S. company saying that he is getting paid, that didn't work for us previously. Do you guys have any solution, or are you guys seeing any trends with the crypto market and investors acquiring real estate, whether it be through crypto or investors of crypto? That was the question.
Yeah, so I can speak to the trends, Ralph, and then maybe you can touch base on
Go for it.
what you see out there, because obviously, I'm just one lender. Ralph has access to many. But some of the trends we're seeing is that in the non-QM space, we're becoming more and more comfortable with crypto. If you go back a year ago, there was a point where we didn't even accept crypto assets as funds to close. As of today, we are. As long as we can document it, we can source the crypto account that it came from, and the funds were liquidated. Crypto income in terms of, investment income, I kind of look at it as dividends or stocks and bonds. Like currently today, dividend income, stock and bond income, day traders, for example, we don't qualify those borrowers using that income because we consider that income a capital gain versus a quote unquote self-employed type of, normal monthly income.
Correct.
But we do have like asset programs that we can use to qualify those borrowers. My point is that what we're seeing is that the industry is becoming more and more accepted and comfortable with crypto as assets from an asset standpoint, using them for funds to close. And I think you're going to see them get more and more comfortable with them from an income statement point.
Okay, and are you seeing, because I was told that right now there is a shift towards that, but they're only considering Bitcoin and Ethereum, and there are so many other coins.
Correct.
Is this going to expand to other coins, or is it just going to be like the mainstream ones that everybody knows about?
Right now, it's the mainstream. You're 100% right. Those are the two main ones that are accepted. I think we are going to see. There's already conversation about opening up to the different types of coins out there, because at the end of the day, they're generating the same asset and the same income, right? So,
Right.
it's evolving. It's evolving. It's evolving every day. It's a market that's going to continue to evolve. We know that the incoming administration obviously is very high on Bitcoin. So I think we're going to see the markets from a mortgage standpoint also evolve. I think that'll be primarily mostly in the non-QM space. Ralph, maybe you could speak to a little bit conventionally what they look at with Bitcoin.
Yeah, no, honestly, we don't see a whole lot of it because, again, the majority of those individuals that are doing the Bitcoins and whatnot are the higher net worth, which are going to be the ones doing the not filing the taxes and going to fall into the non-QM space. So yeah, it's been a challenge. I've been able to use assets here and there with documentation, but it's always going to be it's been an uphill battle, but it's getting better. It's getting better.
Great question.
All right, so we have a couple questions in the chat. As far as down payment goes, Down payment depends on the program, whether it's your bank statement program, your DSCR programs. Uh, they start at what, 90% down, or sorry, 90% LTV, which is 10% down. I mean, there are some options out there that exist with, you know, extremely high credit scores and whatnot, with 5% down on a bank statement loan for a primary residence. But you gotta remember, these in the mortgage world, when you're not putting 20% down, you have mortgage insurance. In the non-QM space, there is no mortgage insurance per se. So what happens is, the less down payment you give, the more the increase you see on the interest rate. So yes, your interest rate can get a little scary looking, but there's no mortgage insurance. So it's kind of, you take one with the other. But yeah, there are options, very score driven, right? So there's, for example, if you have a 700 credit score, you're lucky to get to a 90% or 10% down, but you're looking at an interest rate in the nines. So it might not be in your best interest to do that, right? It might be better to do a 5% down when you get a rate probably in the sevens. I'm sorry, 15% down when you get rates in the sevens. So it just really depends on the scenario. Excuse me, as far as what would make the most sense for the down payment. But are there options as little as 5% down? Absolutely. But math has to make sense. Credit scores have to be there. There's a couple of restrictions with that. We have here large down payment. So flyers, yeah, we have all kinds of different flyers and social media stuff. So just reach out and we'll set it up for you and get it out. It's not a big deal. Easy peasy. Does the rate change depending on the down payment? Yes, absolutely. So if you're giving 10% down, your rate will be, again, somewhere probably in the nines. If you give 15% down, your rate could potentially be somewhere in the sevens. I mean, it's a good jump between 15% down and 10% down. Again, if you have mediocre scores, if you have significantly higher scores, then it won't be that big of a difference. But yes, the rate will change based on down payment.
Mhm.
Any other questions for us?
One more question real quick. Sorry. On
No worries.
on the DSCR loan, if the property is bought through an LLC, can that LLC rent it back to the owner of the LLC? Is that legal?
Yes, absolutely. The LLCs that we're using for vesting should be LLCs that are set up for the purposes of investing in real estate, so they can 100% rent the property back to that, you know, a potential renter or tenant, or absolutely. Yeah, that's generally the purpose of the LLC, of what it should be, operating for real estate income.
Right, because they rent it back to the owner of that LLC.
Oh,
That
you mean
bought it.
the same owner that purchased the property?
Correct.
Well, I mean, technically, no. Technically, if you're purchasing an investment property, closing through an LLC, the intent we expect is that the owner of that LLC who took that mortgage is going to rent that property out to another individual. You know, I'm sure there's ways that can be worked on. We'd have to sit down and map something like that if there was a borrower that wanted to get creative like that.
Yeah, that'd be leaning a little bit into the gray area, so to speak.
So to speak.
I
Yeah,
know. I had to ask though.
Yeah, no worries, man. That's what we're here for.
that's
Yeah,
what we're-
it's one of those, because I remember the idea behind these investment loans. They don't want someone to purchase with a DSCR product as their primary residence. So, you know, technically speaking, you're buying it in an LLC. It's titled in an LLC. It can't be homesteaded. So that's where you kind of are pushing away from the gray area. But as Scott mentioned, the idea is it's supposed to be an income generating investment for the buyer or the owner of that LLC. So yeah, again, it's one of those things we just have to look at and kind of plan for and see how it looks like on paper, because ultimately paper is the one that decides everything.
Understood. Thank you.
Got it.
I like it though, Bernie. Those are real life questions. That's stuff we see today.
Yeah, we see some funky stuff nowadays.
Yeah, we do.
Yes, sir. Anyone else? Where are we located? I'm in Miami Lakes. I'm actually here in the Lifestyle Miami Lakes office. Scotty's actually local. He's lives in Pembroke Pines. I live in Miramar, so we're here in South Florida, where we know the market very, very well. This has, been our market forever. So we're very familiar with the South Florida market and how it works and how the kind of people that are out here.
You know what, Ralph? One thing we didn't talk about, maybe we can bring up real quick, is non-warrantable condos. Just
Yeah.
realized in the slideshow, actually, we didn't talk about them. So you mentioned the South Florida market. That's when it popped in my head. So that's, guys, that's a huge program for us right now. Non-warrantable condos, as you all know, in the state, all of these projects are having to go through their inspections after what happened in Surfside, right? All the stringent requirements was put on them by the state. So our non-warrantable condo, it's estimated, I think it's like, over 70% of the projects in the state are now considered non-warrantable because they haven't met their inspection requirement. And what's happening is, with all these inspection requirements, it's requiring the project to go get all this work done, and then it taps into their reserves, and a lot of their reserves come down. So there's all types of issues there. We are very flexible in the condo market. We have solutions for just about any of those issues. So first, we don't require any inspections. So our condo questionnaire doesn't ask, have you had your 40-year, your 10-year, et cetera, because we're not looking at them at all. In terms of reserves in the projects, we're very, very flexible for two different reasons. So we don't have as stringent requirements in the amount of reserves per se that they need to have, but more importantly is, in our world, we're not looking at just the current year's budget and what that project is collecting in reserves on the current year's budget. We're also looking at what their current balance is in their reserve account, and we add those two numbers together. So if they're only collecting 5%, let's say, in the current year's budget, but they already have a very well-funded reserve account, we can total those two numbers together and a lot of times save loans because that meets the requirement we might need for that program. The other thing we're seeing a lot is insurance, because insurance cost has gone up. We're seeing a lot of these projects taking higher deductibles on their hazard or on their windstorm without knowing how that affects financing, right, in the mortgage world. And so we have flexibility there. Conventionally, I think it's 5% is the cap on the deductibles. We can go up to 10%, for example, on the hazard insurance, and we can go up to 15% on the windstorm insurance. What else are we seeing? We're seeing a lot of litigations. Some cases, these inspections have led to different types of litigations, whether it's the HOA suing the person who did the work because they weren't happy with it, or the person who did the work suing the HOA because they feel they didn't get their payments or their full payments, right? We have a lot of flexibility there. Basically, at the end of the day, if there's a litigation, as long as it's got nothing to do with structural or safety related issues within the project, we can finance in the project. So it's a big topic. Know that if you have condos, if you have buyers interested in condos, all of those options are available. As Ralph mentioned, don't assume anything. Bring it to Ralph. He'll take a look at it, may reach out to me, but there are a number of different ways we can get condos done for you guys.
Even on your listings, guys, I always tell all my agents, if you ever get a listing on a condo, let's try to get as much information on that condo from the association, from the management company. Get a copy of their insurance, get a copy of their budget. The homeowner can grab that. They get that in their mail every year, just so you can analyze it, so that when you put your listing out there and you're getting offers, you know what kind of offers we can potentially accept that will close, right? You can put those in the MLS. We could put those details in together. You could even go as far as having your seller have one of our questionnaires, condo questionnaires, completed, so that can be analyzed and reviewed beforehand. Again, the worst thing you want to happen is to have one of your listings blow up 45 days into the transaction, because now we're finding out that the condo had X, Y, and Z issues with it that could have been found out beforehand and never have taken on that type of customer. So again, just being proactive on your listing side to make sure that you're performing at 100% to your seller and getting their property sold as quickly as possible. But there are a lot of options out there for financing. We just gotta know. We gotta know what the current state of that condo is.
Do we have any other questions out there?
No, that's it. Looks like it's too early for everybody to be. So we'll wrap it up. Guys, I appreciate your time. Appreciate you joining on. If you have any questions, please feel free to reach out to myself, or and I always have Scotty here, and at a moment's notice for any additional information. But again, we're here to help. Reach out, send me a message, call, email, whatever. Stop by the office. Any information that I can give, I'd be more than happy to. And I wish you all a great end of the year, and we'll be in touch.
Thank you very much for everybody. Ralph, thank you for the invitation. I love speaking to realtors about these products and programs because, guys, it all starts with you guys. As I said earlier, without you guys, Ralph and I don't have a job.
100%.
So it all starts with you guys, and I think it's super important that you guys have this knowledge. So thank you for the opportunity to share it with you guys. Happy holidays to everybody.